All right, welcome back to part two of the episode where today we're going to talk about the actual product that you use that we promote for the infinite banking concept. You can use a lot of products, but we use whole life insurance. And why is that, Paul?
We use whole life insurance because, as Nelson explains it in the book, it is the best way to implement the process of becoming your own banker. We talk about policy structure, guarantees and dividends, death benefit, liquidity, stability, and a bunch of other things in this episode. So stay tuned. Enjoy.
Hey, I'm Dave.
And I'm Paul.
And this is the Wealth Warehouse Podcast. All right, we are back. Well, this is part two of the process versus the product, talking about whole life insurance and the infinite banking concept. So why don't we just take a minute to recap the first episode, last week's episode, Paul. So we talked about the process and kind of compared banks to whole life insurance or mutual life insurance companies.
Oh,
some
man.
of the differences there. Yeah, the dog's back. So I'll start us off until you can
He's back. Sorry.
feed the dog a
Yeah.
sedative.
Give him some trazodone, please. Yeah, go ahead.
Yeah, so we compared banks and life insurance companies for the process of banking. Because if you want to do the infinite banking concept, and like Nelson's book states, become your own banker, you got to understand banking. So in banking, the first step is really capitalizing. So what does that mean? It means building up your store of capital. And in this case, call it cash, accumulating cash. And in the banks, you do it by depositing money into the bank. In the life insurance company, you do it by paying a premium. And it all accumulates capital. Next is borrowing. Paul, if you're back on, go for it.
I'm back.
Yeah,
Borrowing, right? You go to the banker and you ask for a loan for a car purchase or maybe tuition or mortgage, right? Well, do the same thing via your policy. You request policy loans instead, right? It's the same thing.
Yep, only
far better.
a whole lot easier.
And easier.
With a life insurance company.
Right.
Yeah. And then there's repayment. You've got structured repayments with the bank, meaning they control all the terms, all the conditions. And then you have unstructured repayment with the life insurance company, meaning you control all the terms, not them.
Yeah. And on a side note, you can't know what that's like until you're doing it.
Yeah. It's, man, what could you compare that to? I mean, there's a lot of things. Like, you don't know what you're missing until you actually have experienced it.
Yes.
And you're like, man, I've been missing out on that for my entire life. You never want to go back.
The best thing since sliced bread.
Yeah, whoever said that it's the dumbest thing I've ever heard. I actually like bread that's not sliced because it's fresher.
Yeah, you leave it.
Like the
when I
stuff you
cook
make at
mine,
home.
I leave it whole as long as until we're ready to
Right, you
cut
don't want to
into
dry
it,
it
which
out
is 10 minutes after I make it.
because that's when it's best.
It's so
Man,
good.
you can just tear it with your hands.
Yeah.
Anyway, I'm getting hungry. Next, in the process of banking, we talked about growth, the growth of your capital. In the bank, they pay you, a fraction of a percent of interest as a reward for letting them hold your money and loan it out and make more money, loan it right back to you and make a whole lot of money on it. And in the life insurance company, you get guaranteed growth, guaranteed interest, or not guaranteed dividends, but dividends that have been paying out for 100 plus years.
Right.
And you can use the money and let it grow at the same time. Not so in the bank.
You get ownership and equity with whole life insurance, right? You own the company, right?
Which ultimately means you control your capital.
You control it, right?
Yeah. And then finally, we hit on safety. At a bank, you're nothing more than an unsecured creditor. The bank owes you something, but it's secured by nothing. And the life insurance company, they owe you a massive death benefit, or more or less your beneficiaries when you die. And that equity you've built in the death benefit is your cash value that you have contractual access to. And they have 100+ year track record of making it work.
And they want to pay the death benefit. They want to pay the death claim. when the time comes. It's why they exist. I've heard the executives say this at least one of the companies. We want to pay the death claim.
That's their whole purpose for existence. Not like an auto insurance company that does everything in their power not to pay your claim, or when you get hail damage on your home,
right?
You know, the same company not wanting to cover your roof replacement. Yeah, life insurance companies pay the death benefit. That's their sole reason to exist.
Yep.
So for more on that, go back to last week's episode. It was a good in-depth discussion on the process of banking. Now, today we're going to talk about the product, because like Nelson says, you can bank with a lot of different things. So you could bank with anything. But in this country, in North America, I guess, so in two countries, the United States and Canada.
2 out of 3.
North America is not a country. I know that. But in North America, there is one product in the financial space that stands above the rest in helping you on a personal level institute the banking process in your own life and in your business. And that product is dividend paying whole life insurance from a mutual life insurance company.
Right. And you said earlier, you know, could I implement the process of IBC with maybe a certificate of deposit at a bank?
Yeah.
Yeah, I could. You could do it with any banking product technically, but the most ideal way, and Nelson explains this, and I'm going to hold up the 5th edition right here. Here it is. Explains that obviously participating dividend paying whole life insurance is the best way to practice or implement the process of becoming your own banker. Simple.
Right. Yeah, and a whole life insurance has a 200 plus year track record. It's been around for centuries, literal centuries. I mean, name another financial product that's been around and stood the test of time like that.
Gold.
There you go. Like precious metals, like God money, like
That's right.
things God created. Whole life insurance is something man created that has stood the test of time. Very rare.
And it's based on just sound principles, right? Like the law of large numbers comes to mind, right? It's not just before we started recording, we were talking about health insurance, which is not really insurance, right?
No, it's subsidizing unhealthy people.
Right.
That's really what health insurance is. Anyway, I don't want to get into that.
Right.
But yeah, this is built by the law of large numbers. When you have millions of policyholders,
Gone through a screening process.
gone through a thorough screening process, and have been intentionally discriminated against based on their physical well-being, just to weed out high-risk individuals. And it's pretty easy. You can't blur the facts like you can, with other parts of your life where you can maybe a con man could go in and make up all these false documents showing they have a ton of money and they're highly successful. You can't do that in life insurance because they come draw your blood. They check your urine. They do an EKG, perhaps. You can't fake that stuff. So they're going to get down to the fine details to determine how much of a risk you are. And that's what determines how much premium you pay for how much death benefit you're going to get.
Yeah, and some of it might boil down to your hobbies. If you're a skydiver, not getting insurance.
Yeah, if you're a wreck diver, not getting insurance. I just saw that movie. I think it's called Deep Breath. Man, it was intense with Woody Harrelson. About these
I haven't seen it.
Underwater, these deep sea divers who go down and fix like oil rigs or something under
Commercial diving.
Several thousand feet deep. Man, that was intense. But yeah, those guys are not getting life insurance.
No, they're not.
It's kind of like the people who need it the most aren't going to get it.
They're not going to get it. Yeah.
No.
Yeah. Jump status for military, it's a no-no. Deployment for military status, deployments upcoming on the horizon, that's a no-no.
I mean, even flying jets. When I flew A-10s
jets.
in the Air Force, and I could not get a policy for myself until I stopped flying. And then I could finally get a policy.
Yep. Commercial aviation, that's okay.
Yep. General aviation, maybe not.
Right.
It depends.
It really depends. That's right.
Yeah. So, so it's extremely precise. They take into account everything about you, even a moral hazard.
Yes.
Like, did you used to use a controlled substance? Maybe you're good now, but did you used to? Or do you use marijuana, and how often do you use it? They've got a lot more lax on that. CBD usage and gummies and cannabis and all that is a little more lax than it used to be, but it's still, there's a limit to how much they're going to accept before they say, no, we're not going to consider you.
Correct. Yep.
Yeah.
And
So
I think that should provide comfort for you. I mean, that's why we're telling you guys this, is that should be comforting to you, that there is and some of you listeners are in that process right now. It is stringent. You've had to supply us with, the underwriter with numerous medical documents or answer question, whatever it is, right? That should provide comfort to you, though. Like, this is not just done willy-nilly and, yep, everyone's approved. That's great. No, it's very strict.
And chances are, if you get a very high health rating from the insurance company, you're probably pretty darn healthy. And you probably already knew that. Like, people who come in who exercise regularly and they eat right and all that, they're like, yep, I knew I'd get a good rating because I'm healthy.
Right.
But, there's little things that you may have no control over that knock you down to just a standard rating, which is still a great rating. It's no big deal.
Which is fine. Yep.
Yeah.
Totally fine.
Yeah, completely fine. But it's pretty indicative. You meet some people and you're like, man, I don't know how it's gonna go with this person. And then sure enough, underwriting comes back and says, no, we're not gonna do that. And we're like, yeah, that's what we thought.
Yes, I've had folks denied just based on their blood work. They did the paramedical exam, blood and urine, and their blood work. Liver function was way off, or kidney function was way off, and it was just they saw something in that test that was like, nope.
Yeah. So anyway, we say all this to just point out how discriminatory this product is, which is why it's lasted for 200 years. These insurance companies are some of the most solid, financially capable and financially solvent companies in the entire world, because they're so conservative and they do not take risk. They absorb risk from us, but they don't like to take risk because they know people, I guess you could say, people's lives depend on what they do, or people's livelihoods depend on what they do.
Yep. And that's why we park our capital there with these companies.
Yeah. So let's talk about the product.
Yeah.
Yeah. So a lot of what people want to talk about is, and a lot of misunderstanding out there is about the structure. A lot of people don't understand there's different ways to design whole life insurance. And a lot of life insurance agents, unfortunately, don't understand that you can structure whole life insurance in a myriad of different ways to suit the customer, to suit the client, the policyholder.
Yep. Yeah, but basically, to practice IBC, right, first of all, it's a mutual life insurance company, right? None of us are issuing these policies from a stock company. We're just not. All the companies that we write for are mutual life insurance companies, meaning they're owned by policy holders, right?
Right.
You take a whole life policy. Nelson says in the book, he's got a little charter in there with a line on the one end is term insurance and the other end is a single pay, and then somewhere in the middle, like a pay to 100, pay to 65, pay to 95, pay to 75, pay to whatever it is, some type of participating whole life product with a paid up additions rider as well.
Yep. And the paid up additions it's exactly that. You're paying up that death benefit with one payment. Now you own that portion of the death benefit completely, so it means you have 100% equity in that portion, which means your cash value is going to rise because your cash value is equity.
Correct.
Yeah.
Yep.
So we use the PUA so you can build that early cash value, and we use the base to build really the foundation and the long-term capabilities of the policy. I would say is more around the base.
Yep. Permanent death benefit.
Yeah. Yep. Now there's also guarantees and dividends in these policies, which is another great thing. You're going to be hard pressed to find another financial product out there that offers you dividends and offers you guarantees at the same time. You're guaranteed from loss. You're guaranteed to gain. You're guaranteed that any dividend that you receive is now therefore the baseline for your policy. It can't be reduced.
You know, this doesn't get, I don't think it gets the credit that it deserves. Once you understand, again, it goes back to that sense of, I don't know, I guess ownership, right? Nelson talks about in the book comparing banks, right? You're earning interest. Well, here you get interest and dividends, right? So that comes with owning something, equity. You're an owner of the company, right? So it's that. I'm going to go too into the weeds, but that is a tremendous advantage, especially over the long duration.
Right. Who gets dividends? Owners. Owners get dividends. Just like stock owners. If you own dividend-paying stock, you have to own that stock. If you're a partner in a company, you're going to get dividends from the company.
That's right.
And that's essentially what we are. Because a mutual life insurance company is owned by the policyholders. That's why it's mutual. It's made up of the policyholders. So we're first in line there. And then this is a key understanding point that a lot of people don't really understand is what is guaranteeing all of this. Everything is what?
The death benefit.
Yeah, right. The death benefit is that underlying asset and therefore the underlying collateral that guarantees that you can go get a loan from the insurance company. The death benefit guarantees everything.
And, the cash value folks and the death benefit are the same thing. One is just the present value of the other. So every year that cash value is trying to catch up to the death benefit, which is quite a bit larger, right? Especially early on. As you get closer to age 100, age 121, the corridor between the cash value and the death benefit is going to narrow. So if that's true, and it is, you want as much death benefit as you can possibly get, because that means you're also going to have a ton of cash value, right? Present value of that death benefit. That is so critical to understanding why one would do this.
Yep.
I didn't understand that when I first started either. I didn't put that together really, but
yeah. So the more permanent death benefit you have, the more cash value you're going to have. Period.
Right. It must be true, and it is. It mathematically has to be true.
And then the great thing about this death benefit, how many other financial products out there that you fund for 1 year, maybe 5 years, maybe 10 years, and if something happens to you, the insured, and God forbid you get hit by that bus full of nuns, and you go early, you graduate early, your family is going to be compensated for multiples of what you ever paid in.
Right. And the younger you are, the bigger that multiple is.
And it's coming to them tax-free, income tax-free. And as liquidity, they don't have to go sell an asset to free up that cash. No, it's coming to them as cash.
Yeah. I've known people that have died, like grandparents, right? Other people that we've known throughout the years, let's say. Everyone that was left behind would have been better off with a tax-free death benefit.
Yeah. Who's not going to be better off?
I don't know, but I would have been better off.
Yeah. Yeah, exactly.
Right? Not selfishly, I'm just saying, like, there were people left behind that really could have used some good advice a long time ago, and they never got it.
Yeah.
Or if they did get it, they didn't listen. It's one of those is true. And that's unfortunate.
Yeah. I forgot what book I was reading, or maybe a documentary I was watching. This guy was recounting, he was in the army, maybe it was Vietnam, and he was getting shot at. He was pinned down. And he said, the first thought that ran through my mind is, I wish I had more life insurance. That was the first thing he thought of when he was facing death in combat. How crazy is that?
Just sitting there thinking about it, like, well.
Yeah. Yeah. Man, that would have been good if I would have had more life insurance, because I'm pretty sure I'm going to die now.
Right.
Yeah. So that that death benefit can't be understated. And it's not a lot of times in the infinite banking concept when people are explaining this or marketing this concept, the death benefit is completely overlooked. And that's kind of put on the back burner. It's just kind of like, hey, it's there, but we don't need to think about it much or concern ourselves with it. Let's focus on the cash value.
Yeah, yeah. If you're talking to us, it is important, and we're gonna obviously we're gonna explain why in multiple ways why it is important, right? It's what makes it all work, but it's a reason. It's the reason we're doing this. The cash value is fine, great. I like early cash value, and I can get to it and not interrupt the growth. Those all the things we've talked about the last couple episodes. That's fine. That's great. It's awesome, actually. But the death benefit is phenomenal. It's nice knowing that it's there.
Yeah,
It's comforting.
absolutely. Yeah, it is comforting. So, and then how about liquidity? How many other financial products can you liquidate or can you access capital from without selling your position or taking a taxable income hit? You know, if you have stocks, you got to sell stocks to get liquidity. Or you could, you know, if you got the right kind of stocks and you have enough of them and you're personally creditworthy, you could get an asset loan from a bank by collateralizing your stocks, and that'd be a great move if you have the capability to do that. But barring that, in order to get liquid, you got to sell.
Yeah, and the typical American, right? And that's kind of how we are going to talk to you on this podcast. We can't obviously talk to everyone's scenario. You know, there's some sophisticated people out there that just know more, but
Right.
most people don't. Right, 95% of people aren't going to do anything that you just said.
Yeah.
5% are and will, but most people just will never do that. And then most people have their money in a qualified plan where they're not doing that anyway, right?
Yeah.
Maybe they're doing a 401k loan up to $50,000 or something if they can. But to your point, yes, you're interrupting the growth of that thing, or you're liquidating it and taking the tax hit on it. So either way, it's not good. It's inefficient.
Yeah. But with this product, you get liquidity without any income taxes from that. It's not counted as taxable income as long as you take it as a cash value loan or you surrender, you know, less than what you put into it.
Right. Right.
There are ways to be taxed on that, but
Yes.
if you do it according to the infinite banking concept and the way we teach you, you'll never be taxed on it.
Never. Yep. We're going to use
And it's there
loans.
quick. It's there quickly,
Yes.
which we talked about last week. So we talked a lot about that last week, you know, what that liquidity means to you personally. So what's your personal definition of liquidity? How quickly will you need funds in the future? And then finally, you know, not finally, but one of the last things we had here is the stability of this product. It's nice to have something that's not correlated to the markets. I mean, just a month or so ago, people were going crazy because the market dropped like 10% in a day.
Right. There's certainly been an uptick in chatter about the stock market, right? And if you're smart and if you're young enough, you can just hold your position, right? Maybe buy more, whatever you're going to do. This is not an investing podcast, so I'm not going to talk to any of that. But, you know, yeah, it is nice having a non-market correlated asset because I don't check what the Dow is or the NASDAQ or the S&P. I just don't. People talk about it and I don't really care. I hate to say that. I do care, but I'm not worried about it.
Yeah, right. We do care because that is, you know, friends and family's well-being, a lot of them. But yeah, like you, I don't worry about it. It does not affect my day whatsoever. You know, some people check the stocks every day. I bet a lot of retirees, there may be some who are tied to that every single day. And it could determine whether they have a good day or a bad day, or at least a good morning or a bad morning when they look at those numbers.
So I heard Dr. Paul Cleveland. This is a perfect place to insert this. I was just flipping through YouTube maybe it was earlier today, and I saw a little. He was on the NNI podcast, and he said, you know, Nelson used to say that living the IBC way of life is just a peaceful way to exist, just a calm way to live, because you're not doing those things. Who wants to be in their 70s or 60s or 80s or whatever and looking at what the Dow is doing? I don't
Yeah.
want to be doing that.
No way.
I want every day to be Saturday.
Yeah, I don't want to be calculating how many. Man, I need to die a little earlier now if I don't want to run out of money.
Yeah, like hopefully I don't outlive my money. Like that's not any way to live. And we've got content on, and we've had Ryan Fleming on. We've talked about sequence of returns risk and how this product and implementing this process is just a great way to it's a great thing to add to your overall just portfolio for that reason. So that when
Exactly.
the market is all over the place or it is down, you can just I've got this thing over here, and wow, the dividend was $100,000 this year. I can just pull $100,000 of cash value alone and live off that for a year or something.
Yeah, amazing. And yeah, I love what you said that Paul Cleveland talked about, because I remember I got to meet Nelson right before he graduated, and you can see him on video, and you see This Is Nelson Nash, the documentary on Nelson. I've never been around a man with more peace and more calmness than Nelson Nash.
Yes.
Like it was just so evident. His presence was just peaceful and calming. He had no worries, financially at least, because he knew he was good. He knew his wife was going to be good, and he knew his family and his legacy for generations were going to be great.
Yeah, it would be nice to kind of to graduate with a smirk.
Yeah, like
just kind
you
of
graduate like you guys are going to miss me, but just wait what's coming. Just wait for what's coming. It's going to ease the pain.
You'll forget real quick.
You'll forget about me real quick. Yeah. At least you can go cry in your margaritas on the beach.
That's right.
But
no, that's the way it ought to be. And then David told that story about the two dads or whatever, and that kind of relates. One's the conventional way, and one did the Nelson. Nelson was the other guy, obviously, and it's just totally different. Both did well, but just totally different at the end. And I think if people could just think with the end in mind first when you're exploring this.
Yeah.
What does it look like when you graduate?
Well, and I can speak from personal experience, firsthand experience. I've been doing this for 15 years. I've owned policies for 15 years. And I can say without a doubt, I'm so much more, at peace and confident about my financial position than I've ever been. And each year, I get more peaceful about that and have more calmness, regardless of the storms going on in life, the financial storms, because I've instituted this process and going on 15, 16 years now, like we repeat Dan Sullivan's quote many times, if you have the money to solve a problem, you don't really have a problem.
Right.
So now I don't look at things as being a problem. I look at it as being, okay, how do I want to best solve this financial dilemma? If there is a dilemma, I know I can snap my fingers and it's done because I've been capitalizing for 15 years. But it's so peaceful. It really is.
Yeah, and for those of you first, just starting out, or you're in the underwriting process, or you're just a person exploring this, you don't know this yet, but 20 or 30 years from now, you're going to look back, you stick with it, and you're paying, the premium that you can pay and that you should be paying if you want to do this properly. You're going to look back and not have one regret. And if you do have a regret, it's that you didn't pay more premium.
Yeah.
That will be your only regret. It will be. I get a client right now is going to double his premium.
Right.
And I told him, I was like, okay.
Yeah. I've got a young client in his mid-20s going on his third policy.
Awesome.
Within 2 years. It's like, the second time he still didn't get it right. So the third time he's really trying to maximize it. So maybe I can blame myself, but I'm pretty confident. I stressed, I think you can do more. And I think you're capable of more than you think you are, but do what you want to do right now. And then come back to me a year later and tell me I'm wrong.
Yeah. Go back to our holes in the bucket episode there from a couple weeks ago. Was that this week? Last week? Has that even come out yet?
I don't even know. I think so.
I don't know either. But
Yeah.
I was talking to a client real quick, and I just want to, I know we need to wrap up, but, this guy is sending $60,000 to $80,000 a year to the federal government tax.
Yeah.
And I was like, dude, that's a big hole in that bucket.
Yeah.
We can plug it.
Right.
So
that episode we talked about, what if you could save 5% of what's leaving your personal financial economy every year? 5%. So if he could save, if he's sending out 60 to 80,000 in taxes, he could easily capture way more than 5% of that permanently.
Yes.
And be just fine.
Yep. And yeah, we're going to do that.
Yep. That's episode 169. Go back and listen to that one for more on that topic. Build more wealth by not losing money versus earning bigger returns.
Ooh, what a great title.
It's all about the way you think.
Somebody said that.
Somebody very, very wise said that. All right. Good. Hopefully that helps clear up, or give you some oversight on the product if you didn't know all of that already, or a refresher on the product if you did know that. But again, if you didn't listen to last week's, go back and listen to that one too. That, I would say, is the more important one. The product is the product. The process, you got to know that. And that's what's really going to make this concept work for you. The product's going to work with or without you.
Yep.
And that's where you come to us for help.
That's right.
So if you got any questions, reach out, leave us a comment, leave us a 5-star review. We haven't asked for that recently, so leave us a 5-star review if you haven't. We love those. It gets us out there in a broader
Or leave us a 1-star review, because we had one of those too.
But if you're going to leave a 1-star, you better leave a comment, because I want to read it.
And your name.
And not your fake name, like
your fake name.
Astro Jim or whatever. I'm going to use a fake name because I'm scared to use my real name, leaving a 1-star review. But yeah, no, I like reading those because they're funny, frankly. Anyway, all right, everybody, have a great week. We'll talk to you next week. Until then, control your capital.
Or somebody else will.
Hey, thanks for listening, everybody. If you'd like to have a conversation with us to see how you can become your own banker, or if you have any questions or topics you'd like us to tackle in a future episode, please send us an email to davidandpaul@theibcguys.com.
And subscribe and leave us a review if you're on Apple. Follow and leave us a 5-star review if you're on Spotify. And please share this with your friends. We'll see you next week.